options are my favorite asset class in finance, and if we're talking about option pricing, it is very important to understand the difference between OTM, ATM, and ITM. As I said before, they stand for out of the money, at the money, and in the money options. So obviously, the premium you pay for in the money option is much higher than the one you pay for out of the money option, because that option is in the money, so it is profitable already. So investors price it higher, right? And when it comes to option analysis, you have to sort of understand what a delta is. And delta is a sensitivity measure that measures how much the price of your option moves relative to the price of the underlying asset. And you have to bear in mind other Greeks as well. Greeks are different sensitivity measures such as gamma, theta, and vega. They all measure sensitivity, but they are more niche, so they're more advanced than delta. But you need to understand what delta is, most importantly. There are two different sort of types of options that have nothing to do with their country of origin. It's either European option, European style option, or American style option. So European style option is the one that can be exercised only at maturity and not before, while American style option, can be exercised at any time. So obviously there is a bit of a complication for American style options, so you cannot price them with Black-Scholes model that all financial institutions use. And also, I use Bloomberg to price option with Black-Scholes. I'm not doing it manually, right? American options, though, American style options, they have this. So the value of an American option represents the sum of time value of an option and intrinsic value. So intrinsic value is the value that can be realized from exercising the option right now, while the time value represents the possible, the chance that this option ends up in the money in the future. So the closer to maturity, right? The closer to maturity, the lower the time value is, the higher the intrinsic value, right, becomes. The longer to maturity, the higher the time value is. So obviously it is very important to understand. So you cannot value American options with Black-Scholes. You have to use binomial trees for that. Or, you can use some different software like Bloomberg for estimating American options as well, for pricing, American option with binomial trees. And I like it, to be honest. And I do find options to be the best financial asset that there is. And I would like to move into them in the future as well. I would like to be more advanced in options, yeah. When it comes to the creation and construction of your own portfolio, it is extremely important to bear in mind the significance of beta, which is a key sensitivity measure. It measures how sensitive your asset price is to the market. It also, relates to correlation as well, which is a more quantitative measure that is being used in construction of the portfolio. So you want your correlation to be negative, so your stock move opposite directions to achieve a diversification effect, although you have to be aware of the fact that there is a limit for the diversification. So after, say, 30 or 40 positions, the marginal benefit of diversifying even further is lost. So it doesn't make any sense to diversify into infinity. Beta is the core sort of assumption of the capital asset pricing model, which is a key model in finance overall. It is the very, very basic, although it received quite a large number of critiques, although it has been criticized quite a bit. If other people, they started, so new models emerged and they were opting to, replace the capital asset pricing model due to its irrelevance, although CAPM is still being used in finance right now during these days. So the first one was Farmer French three-factor model. And Kenneth French, one of the authors of this model, apart from Farmer, is the one who publishes all of his financial information online on his website, Kenneth French, and we use it for sort of financial analysis all the time to drive and to sort of estimate these different risk-free rates, market rate, etc. Although I do it through Bloomberg because I do not necessarily trust him, but sort of different sort of financial analysts could use Kenneth French website for that. And so my point is that Farmer French three-factor model, they added 2 additional factors that could technically explain the movement of the price. So these factors were size and value, if I'm not mistaken. And then Farmer French, and then another person, the student called Cohart, implemented the momentum factor into this model. So he added a 4th factor called momentum, and he argued momentum is very important for sort of price movement and explanation of it. Although Farmer French were quite skeptical about it, and overall they came up with a new model called Farmer French 5-factor model, which is the most complicated so far, and also a lot of PMs should use this model to valuing assets, and they do not. Most of them, especially us, we use CAPM most of the times. 5-factor model included profitability and investment factors to the 3-factor model. And there you are. We have a 5-factor Farmer French model now.